Hello students, hope you all are doing great. I'm Achal Chaudhary working as an assistant professor, BBA department in St. Andrews Institute of Technology and Management. So students, I'm back with my online lecture series of company accounts. Students, it's a lecture number 3 from unit 3. So in previous two lectures, we have completed the final accounts with its theory and numerical. So we have completed half portion from the unit 3. So now the remaining topics are accounting standard. So in today's video, we are going to start with the accounting standards, its features and accounting standard number 4 and 5. So we will discuss both of the accounting standards in detail. So let's get started. So let us start with the today's lecture. Accounting standard. What does it mean? An accounting standard is a common set of principles, standards, and procedures that define the basic of financial accounting policies and practices. Generally accepted accounting principles form the set of accounting standards widely accepted for preparing financial statements. So generally it improves the transparency of financial reportings that is all over the world. So what happens students ki agar suppose if there are no accounting standards, so what will company do? Company starts manipulating their data so that more and more investment can come in their organization, right? So agar आपको suppose there is no foundation, कोई भी फाउंडेशंस नहीं है अकाउंटिंग स्टैंडर्ड्स की, तो आप क्या करोगे? आप अपना ज्यादा से ज्यादा प्रॉफिट मेंशन करोगे सो दैट क्या होगा कि आपके पास ज्यादा से ज्यादा इन्वेस्टर्स हों और आपका जो भी वर्क है दैट विल गो स्मूथली. So this is how accounting standard works. They makes a transparency in the financial accounts so that banks, investors, and regulatory agencies count on accounting standards to just to ensure information about a given entity is relevant or accurate. अगर relevant or accurate नहीं होगा, if there is no accounting standards, then how can someone be rely on some like information on someone's financial position? So in that case, nobody will like feel secure that if their investment is on a right path or not. They will feel insecure anytime. So for that purpose, accounting standards has been maintained so that there will be a transparency in the business. Benefits of accounting standards. First is attains uniformity in accounting. So uniformity here means that everyone is following the same formats, same rules just to ensure the reliability. So accounting standard provides rules for standard treatment and recording the transactions. They even have a standard format for the financial statements. As I have already shared the formats of balance sheet, P&L, trading account. What is it for? It's just for the uniformity. So each and every person will follow the same pattern, will follow the same format so that there will be a uniformity in their work. Next is your improves reliability of financial statements. So it is essential these statements present a true and fair picture of the financial situation of the company so that everyone can rely on the data. They can trust on that particular financial positions so that they can invest and their interest will be saved. Next is prevents frauds and accounting manipulations. These standards make it difficult for the management to misrepresent any financial information. It even makes it harder for them to commit any fraud, by which investor interest is also saved. अगर कोई fraud ही नहीं होगा, if there is no manipulation, then there will be no misrepresentation in the financial statement, so that investors' interest is also saved, right? Next is assist auditors. How it helps in auditors. So here clear policies and procedures are mentioned in journal so that anyone or everyone can check on these policies and work accordingly. So and in case an auditor checks that the policies have been correctly followed, then he can be assured that the financial statements are true and fair, right? So it is also making the work easy for the auditors because they need not to check about the any kind of fraud, misrepresentation. They have a proper policies, procedures along with them so that they can just match the things, and if it is according to the format policies, then it is ensured they are ensured that the policies and financial statements are accordingly they are fair. Next is your comparability. Since all entities of the country follow the same set of standards, their financial accounts become comparable to some extent. Of course, अगर पूरे world में same format follow होगा, same accounting standards will be followed, then you can easily compare the data. The users of financial statements can analyze and compare the financial performances of various companies before taking any decision. So, students, why do we prepare the financial statements? We are preparing it just for the investors. We are just preparing it to ensure that we are having a profit or loss, just to clear the things. Like our company is having a loss or profit, and if there is a profit, then how much it is, how many investors are there. So each and everything are presented by the financial statements. So if it is true and fair, then everyone will want to invest in your organization. They will feel safe that this organization is working on the proper accounting standards. It is working according the accounting standards. So the goodwill is also increased. So in that case, what will happen? It's your benefit only because you are following the same standards, same accounting standards, although there can be a loss. But that doesn't matter. If you are working accordingly, then investors will feel like that at least they are safe in investing in your organization. So this is how we follow the accounting standards. This is why we follow these standards. Limitations of accounting standards. So students, what happen if something is having its advantages, its benefits, then it is also mandatory that it will be having a difficulties, limitations, or any kind of demerits. So it is very appropriate, it is very you can say that ये होता है, it is a reality. If something is having a merit, then it will be having a demerit as well, because nothing is accurate. So first limitation is difficulty between choosing alternatives. So it's not a kind of demerit, it's kind of a limitations. Limitations means like difficulty in choosing alternatives. You are having a lot of alternatives available with you, but now you have to think like which alternative will be best for you. Like there are many alternatives available, for example LIFO, HIFO, and your weighted average, simple average. You are having a lot of alternatives available with you. So now the question arises like which will be the best alternative, which will be best suited by our organization. So it's quite difficult for you just to choose out the from the alternatives. Next is your restricted scope. So accounting standards have some limited restricted scope, because there are laws. Every country has its own laws. So here accounting standards are made up of after considering all the laws, so that they are not going to harm any kind of laws. They are not working against any kind of law regard that will be regarding any country. So here the scope is somehow restricted by those particular laws of a country. Accounting standards. Students, basically we have 32 accounting standards which are present, but we will study only six accounting standards which has been mentioned in your syllabus. So first is accounting standard number 4. So it deals with the contingencies and events occurring after balance sheet date. So students, here contingency means it's a kind of situation which arises when there is a situation for which the outcome is uncertain. When the outcome is uncertain, so that is understood as a contingency. So here AS4 is not applied in the following cases: liabilities of life insurance and general life insurance enterprises, obligation under retirement benefit plans, commitments arising for long-term lease contracts. So it will not be applied in following three situations, and it deals only with contingencies and events occurring after balance sheet date. Events occurring after the balance sheet date. So here, what are those events? What do you understand by events which are occurring after the balance sheet date? So let us understand about it. Events which occur between the balance sheet date and the date of approval of financial statements by competent authority. ऐसे statements which are occurred after preparing the balance sheet and before the date of approval of financial statements. So those statements are known as extra adjustment entries, or you can say events which has been occurred after the balance sheet. So there are two types of events: those which provide further evidence of conditions that existed at the balance sheet date, means there is some kind of evidence maybe that has been already happened in past, so we are aware about it, or those which are indicative of conditions that arose subsequent to the balance sheet date. Maybe वो event अभी हुआ नहीं है, but you are having some sort of idea, you are having some sort of indications that it will be going to arise. So these are the two conditions, these are the two types of events. So what will be the accounting treatment for those kind of statements, for the like contingencies or events that has been occurred after the balance sheet? So what will be the accounting treatment for those? So let us go through the accounting treatments. Adjustments are required if we get additional information which can materially affect the amounts relating to conditions existing at balance sheet date. So if there is any kind of expenses or any kind of transaction which will materially, like जिसका पैसे में काफी there is, it's a huge amount, it will have a impact on balance sheet. So it is very important to mention that transaction into additional information. Next is no adjustment is required if the event does not relate to the conditions existing at the balance sheet date. Suppose there if any kind of event occur which is not like impacting, having an impact on the balance sheet, then in that case there is no adjustment is required. Events which do not affect the figures of balance sheet statements but can significantly influence decision making, that must be disclosed in report of approving authority. Suppose there is a event which has been occurred, but that event is not having an impact on the figures, means it's not in a monetary form, but yes, it is very important for the investors to know about that particular event. So what will a company do? They will disclose it in report, in their financial report of the approving authority. Next is certain events taking place after the balance sheet date are reflected in financial statements because of statutory requirements. Many times it happens like in the balance sheet there are many kind of events which are not having kind of so much that impact, but they are bounded with the statutory requirement. So it is very important to mention those events in the financial statements. And last is here events that may indicate that the enterprise ceases to be going concern requires a proper disclosure. When there is a event which can focus like which can harm the enterprises going concern concept means जो enterprise को इतना impact कर सकता है that it will lead to the closure of that organization, then it should be properly disclosed to the concerned authorities. So it should be disclosed in their accounting statements. Disclosure. According to the Accounting Standard 4, there are certain terms, certain events which are required to be disclosed in the financial statements or the financial reports so that there will be a transparency in the organizational financial statements. First is disclosure is required only in respect of those events which materially affect the financial position, as I told you, like which are having a huge impact on the financial position when there is a huge amount is involved which will materially affect the financial position, then it is required to disclose those events. Next is your disclosure of events in the report of approving authority should be comprised of the following statement information. So there are two types of events which will be shown in the report of approving authority. After approving authority assign you to mention those events in your statements. First is nature of the event. When the nature of the event requires to be mentioned in the position financial statements, then it is mandatory to mention those events or an estimate of their financial effects or a statement that such estimates can't be made. When there is not possible to make a statement estimates for those particular statements, then it is required to mention those estimates so that there will be no harm to any kind of investors. Next is your accounting standard number 5, which deals with the profit or loss for the period, prior period items and changes in accounting policies. So let us understand what all are included under the accounting standard number 5. Objectives of accounting standard 5. First is to prescribe the classification and disclosure of certain items in the statement of profit and loss so that students all enterprise can prepare and present such statements on a uniform basis so that there will be a uniformity in the transactions. Next is increases the comparability of the financial statements. So it is working on the comparability of the financial statements so that anyone, any organization can compare its financial statement with any other organization which they are considering as a benchmark organization. Next is requires classification and disclosure of extraordinary item and prior period items and the disclosure of certain items within profit or loss from ordinary activities. So it is also required to classify and disclose some extraordinary items if it is there in the organization. Next is it also specifies the accounting treatment for changes in accounting estimates and the disclosure to be made in the financial statement regarding changes in accounting policies. So it requires if there is any kind of accounting estimates, so it is required to be to mention or disclose that estimate in the financial statements. Next is It does not deal with the tax implications of extraordinary items, prior period items, changes in accounting estimates, and changes in accounting policies, for which appropriate adjustment will have to be made depending on the circumstances. So here it's not an objective to deal with the tax implications of those extraordinary items. Here we will just disclose those extraordinary items, but we will not deal with the tax implications. Then last topic of the day is what are the disclosure requirements which has been mentioned under accounting standard number 5. So here are the financial statements. First is ordinary items. So if their disclosure is relevant to explain the performance of the enterprise, so in that case that item should be disclosed separately. For extraordinary items, it should be separately disclosed in the statement of profit and loss, and if it is required to be disclosed, if it is important or relevant to be disclosed, then it should be disclosed in the P&L account in a manner that its impact on current profit or loss can be perceived. Next is your prior period item, sorry. So it should be disclosed separately in the P&L statement if it is having an impact on the current profit or loss. Next is your changes in accounting estimates. The nature and amount of a change in accounting estimate which has a material effect. I am again repeating, which has a material effect in the current period or which is expected to have a material effect in subsequent periods. So it should be disclosed in your P&L account. And last is changes in accounting policies. The effect of any change in accounting policy, if material, should be disclosed in financial statements of the period quantifying the impact. Where the impact cannot be quantified wholly or in part, the fact should be disclosed. So here is the disclosure I have mentioned when you have to disclose the certain items and in which situation. So in short, whenever it is important for the accounting statements to have that detailed particular disclosures, or in case of having a huge impact on the materiality of that statement, then it needs to be disclosed in the financial statements. Well, that's it for today's lecture. So in next video I will be continuing unit 3. So here are the questions which has been asked earlier in your university exams. Question number 1. What do you understand by accounting standards? Explain it along with its feature. Question number 2. State the basic features of accounting standard number 5 with suitable example. So you have to solve these questions. I hope you are clear with today's lecture, and if you have any kind of question in your mind, so do let me know. I will arrange a doubt session for you to clear all your doubts. Thank you for your cooperation and interest. Stay tuned for more videos.